Michael Burry, the investor who made $700 million shorting the 2008 housing market, is currently holding massive put options against Palantir. He is predicting a 60% drop for a stock that previously soared 1,400% on pure AI hype. Watching a celebrated AI stock face a 60% collapse feels like buying a winning lottery ticket only to discover it was printed on dissolving paper.
Palantir's artificial intelligence platform directs critical operations worldwide. It commands military battlefields and, fast food workflow optimization.
Burry stamping a sub-$50 valuation on this tech giant operates as a massive strike against blind technological optimism. He is kind of leading everyday investors to question the actual foundation of the AI boom before the entire sector.
Read the latest findings from the Stanford Graduate School of Business. Researchers built a deep learning graph transformer. That system functions like a massive digital map connecting the hidden dots between thousands of seemingly unrelated financial accounts over 14 years of holdings data. They trained this system, and it accurately predicted the 2020 COVID market crash.
Wait, if the machine actually predicted a global crash accurately, people should trust it?
Economists distrust predictive AI for the very same reason Burry distrusts Palantir. They hate algorithms digesting massive data sets to forecast financial disasters without showing their work.
Palantir runs highly classified war room analytics. A projected collapse in their stock price signals that faith in AI automation is cracking at the highest institutional levels.
Blame the black box mechanism. Stanford researchers Antonio Coppola and Christopher Clayton identified the resulting Faustian bargain in these systems. Advanced AI models successfully detect real-time distress in shadow banking entities.
Meaning those obscure, sort of less regulated financial corners, hedge funds and exchange-traded funds.
The models spot a mathematical pattern signaling an impending financial catastrophe. They physically cannot generate an explanation for the economic trigger. It is pure math, lacking any human reasoning process.
The system provides a glaring warning about a structural weakness while offering zero insight into the cause. Relying on an AI that knows a crash is coming but cannot explain the cause feels like a doctor predicting your exact date of death but refusing to tell you the disease.
That terrifies anyone managing a retirement account.
Regulators cannot freeze global markets based on a notification they do not understand. How do authorities possibly act on a blind?
Expect market participants to manipulate that regulatory hesitation. Hedge funds intentionally shift their massive risks to invisible corners of the financial system to avoid the AI's gaze.
Traders recklessly buy highly vulnerable assets, operating under the assumption that the algorithm will trigger a central bank bailout before their portfolios collapse.
The predictive safety net manufactures the specific hazard it was designed to eliminate. Coppola and Clayton defined the only viable path forward as model-informed regulation.
You sort of end up using the machine as a high-powered radar, keeping a human at the steering wheel to, interpret the signal.
AI handles the massive data crunching required to spot early warning signs in the shadow banking sector. Human economists then apply traditional causal models to understand the mechanics of the impending crisis. We retain the predictive power without surrendering causal clarity.
For you listening today wondering what this means for your money, it leaves a chilling final thought. If central banks use AI to constantly predict and prevent human financial panics, do the algorithms eventually just start regulating human emotion itself, leaving us completely out of the equation? Goodbye.